Have you ever watched Ethereum's price skyrocket in minutes, only to crash just as fast? Behind those dramatic moves can lurk a classic market trap known as the pump and dump. In this video, we'll break down how these schemes unfold on major exchanges like Binance, the warning signs every trader should recognize, and the smart steps you can take to protect your money. Whether you're a seasoned investor or new to crypto, understanding this hidden side of the market could save you from costly mistakes. The pump and dump in the Ethereum market typically begins with a coordinated effort by a group of speculators or fraudsters who identify a period of low trading volume or a moment of market uncertainty. Ethereum, being one of the largest and most liquid cryptocurrencies, is not as easy to manipulate as tiny altcoins, but temporary inefficiencies or highly leveraged derivatives markets can create opportunities for short-lived price spikes. The organizers quietly accumulate ETH over days or weeks while spreading optimistic chatter across social channels such as Telegram groups, Discord servers, X formerly Twitter, Reddit forums, or even through misleading news blogs. They might point to upcoming upgrades, institutional adoption rumors, or a fabricated partnership to create an emotional narrative that attracts retail traders. At a predetermined time, they launch an aggressive buying blitz, using market orders and sometimes automated trading bots to rapidly push the price higher. This sudden surge triggers algorithmic trading systems and momentum indicators on platforms like Binance, causing other traders, especially those watching breakout signals, to jump in. Fear of missing out FOMO spreads, and more buyers pile in, reinforcing the upward spiral. A pump and dump in the Ethereum market typically begins with a coordinated effort by speculators or fraudsters who identify a period of low trading volume or market uncertainty. Ethereum, being one of the largest and most liquid cryptocurrencies, is harder to manipulate than tiny altcoins, but temporary inefficiencies or highly leveraged derivatives markets can create windows for short-lived price spikes. Organizers quietly accumulate ETH over days or weeks while spreading optimistic chatter across social channels to set the stage. To build excitement, these actors invent or exaggerate stories surrounders of upcoming network upgrades, partnerships with major financial institutions, or supposed insider knowledge of regulatory breakthroughs. They seed these stories across Telegram, Discord, X formerly Twitter, and niche crypto blogs, making them appear organic and credible. The aim is to create an emotional narrative strong enough to override rational analysis. At a predetermined moment, the group launches a coordinated buying spree. Market orders and trading bots drive the price sharply higher, triggering technical breakout signals that attract algorithmic traders. Early retail traders, seeing the sudden momentum, jump in, reinforcing the upward move and validating the illusion of a genuine rally. Fear of missing out FOMO is the key fuel. Traders watching green candles and hearing bullish commentary often abandon their plans, buying simply because others are buying. Even experienced investors can rationalize the surge as legitimate, assuming they are witnessing an early stage of a major Ethereum rally. Social platforms act as amplifiers. Influencers aid or part of the schema share screenshots of soaring charts, boast of once-in-a-lifetime gains, or leak so-called insider tips. Trending hashtags and viral posts can reach tens of thousands of retail investors within minutes, dramatically increasing the buying pressure. To maintain the illusion of intense demand, manipulators may engage in wash trade buying and selling to themselves to inflate Vollmeyer spoofing, where they place large fake buy orders to fool others into believing deep market support exists. Algorithmic bots that react to order book depth can accelerate the pump without realizing those bids are not genuine. Ethereum's active futures and perpetual swap markets magnify the effect. A sudden spike can liquidate short positions, triggering a short squeeze in which bearish traders are forced to buy back ETH to close positions, adding yet more upward pressure. Sophisticated manipulators time their campaigns to exploit high open interest and funding rates. As the price climbs far beyond its sustainable value, the original manipulators begin the dump phase. They offload their large ETH holdings in small, disguised chunks to avoid detection, selling into the very demand they have created. Because Ethereum markets are interconnected, these sales ripple across spot markets, perpetual futures, and decentralized exchanges, adding to the sudden liquidity shock. Retail participants, seeing only green candles and bullish tweets, often keep buying until the selling pressure overwhelms them. Eventually, the order books thin out and a sharp reversal begins within minutes, sometimes over several hours. The rapid drop triggers stop-loss orders and margin calls, cascading into a steep decline. Latecomers watch their unrealized gains evaporate or turn into heavy losses, while the instigators walk away with profits captured during the euphoric peak. Even a highly liquid asset like ETH experiences quiet periostale night hours or weekend when order books are thinner. Pump groups often strike during these windows, knowing a smaller pool of active traders allows them to move the market with less capital. When global participants return and see a large spike, they may join in, extending the surge. The original organizers rarely wait for a specific price target. Instead, they watch sentiment and liquidity, beginning to sell when chat rooms overflow with euphoric messages or when mainstream coverage starts. Early selling is often disguised in small increments so as not to tip off the crowd, while late buyers unknowingly provide the liquidity for the insider's exit. When selling pressure finally overwhelms buying interest, Ethereum's price can fall just as quickly as it rose. Automated stop-loss orders, margin calls, and cascading liquidations accelerate the drop. Traders who joined late may see their gains vanish within minutes, and many panic sell at a loss. A violent reversal in ETH can drag the broader crypto market lower. Altcoins often follow Ethereum's price movements, and shaken investor confidence can lead to temporary declines across multiple assets. Liquidity dries up as traders retreat to stablecoins or fiat, magnifying the overall downturn. Major exchanges such as Binance deploy sophisticated monitoring systems that track suspicious patterns, abnormal order flows, and linked accounts. They can freeze assets, demand additional identity verification, or share data with regulators when manipulation is suspected. These measures deter some activity but cannot eliminate every scheme in real time. Many jurisdictions classify coordinated market manipulation as a crime. Participants in pump and dump operations risk civil fines, account bans, or criminal prosecution. Regulators increasingly view large-cap crypto assets like Ethereum as falling under securities or commodities laws, bringing stiffer penalties for manipulation. Education and discipline strategy are the best protections. Traders should confirm news through reputable sources, avoid making decisions based solely on social media hype, and set strict entry and exit rules. Using limit orders, maintaining diversified portfolios, and resisting leverage can reduce vulnerability to sudden swings. Understanding the anatomy of a pump and dump is not a playbook for participation but a warning. Genuine Ethereum price growth comes from verifiable fundamental upgrades, ecosystem development, or macroeconomic factors secrecy or urgency. If a price move appears too fast and too good to be true, it almost certainly is, and the smartest move is to stay on the sidelines. Regulators and exchanges continually monitor for this behavior. Binance, for example, employs surveillance algorithms that flag unusual order patterns, wash trading, and coordinated pump groups. In many jurisdictions, market manipulation of this sort is illegal, and participants can face penalties, frozen accounts, or criminal charges. From a defensive standpoint, traders can protect themselves by scrutinizing sudden volume spikes, avoiding decisions based on unverified rumors, and setting disciplined entry and exit rules. Sustainable Ethereum price movements usually coincide with fundamental catalysts as confirmed network upgrades, ecosystem growth, or macroeconomic shifts rather than anonymous calls for a moonshot on social media. Understanding the anatomy of a pump and dump is therefore not a playbook for participation but a warning. If a price movement looks too fast, too steep, and too good to be true, it almost certainly is.